Hey everyone, this is going to be a quick tutorial for the StockCast Signals feature that we just released. So I'm going to run you through this. It's going to be very short, simple, and concise, and I'm also going to show you how to take a strangle trade and use these signals, based off of how we created this system properly. So let's go ahead and start. So once you open up your dashboard right here, you can see everything that we have going on, and in other tutorials I'll have this all broken down, explain it, but we want to go right here for the signals. So we'll click right here and we can see the newest signals that populate. So our signals populate after hours when we're able to catch all of the data that we created that came through the market for the entire day, and we run our algorithms. As you can see right here, Netflix was one that just previously alerted last Friday on February the 3rd. And these trades, these hedge trades, they all alert as hedge trades because the eye data, we can see their portfolios and we can see when they become unstable in those tickers. And once they become unstable, that's when we'll strangle their position with the hedge trade with both a call and a put. These are long calls and long puts. And we're doing them for 30 days out, and we just let them move that ticker around however they do. We usually lock in profits anywhere around 20 to 30%, and it's very stress-free for the most part. So let's say, we like Netflix. Okay, if we want to look up any other information for it, we can just click on it, have some more resources, news, the calendar stuff, and whatnot. But going back to the signals, we like Netflix. We'll decide to take that trade. And with the next update that we're going to push later this week, we're also going to signal the contracts to be taken, if you want, for these hedge trades. But they're basically just going to be contracts that are 30 days out, right at the money for the strangle, around this price for where it closes out at. So let's actually do a demonstration with NVIDIA, ticker NVDA. We can look back in the past and see that NVIDIA had signaled on January the 13th. So we would have got this after hours on January the 13th. And as long as the stock price doesn't do anything drastically, the following day or by the time you take it within, a few days, you have a few days to actually enter most of these trades. But as long as it doesn't do anything drastically, for instance, we'll just say this is 169. And if this thing by the pre-market was up to 175, yeah, I wouldn't take it. But if it was 169.50, 170, that's fine. So just use your discretion right there. So ticker NVDA. Now, we're going to pull up the chart right here, and obviously we're looking back on it, but these were live signals. So we'd have got this after hours on the 13th of January. So the first opportunity we would have had to enter this trade would have been at the opening on the 14th, the 17th. So the 13th was a Friday, apparently. And here we are on the 17th of January, and this ticker would have opened up at 168.99. That's cool. So if I would have took the hedge trade here, and let me pull over TOS for you. All right. So I have no video up, and this is TOS on demand, and I'm going to move to the 17th. And once this updates, I'm going to take the contracts that are 30 days out, within that 30-day range. And again, by the end of this week, we'll have that update pushing those contracts based off the price for when it closes. So here we are. NVIDIA, we have these contracts right here, 31 days out, and more than likely your spread up here is going to show single. meaning these are going to be single leg contracts. This is normally how retail traders trade. They usually just come in here and just take a single leg and that's it. But you're at the mercy of the market. The thing is, since we have figured out how these wells trade and we know when they become unstable in their positions or just very, very heavy, we know when the best time is to take a hedge trade. And this is why this strategy can work now. Normally, people would just try to take a strangle, which is one call and a put of the same expiration. And if that stock doesn't do anything, then those contracts just kind of get killed off. And that's pretty much it. But what they didn't know is, do the wells have any interest here? And that's usually why that happens. But now we know, we can see that. So I could do this the simple way, and I'm going to actually demonstrate that here, but I'm going to show you how to change this to the strangles in a second. But the simple way is just taking the one call and one put, and I'll do that in a moment. But if you want to go right here and change this to strangle, here we go. This is what it will look like. And this will be for the current price right here, so you can see this one would say 175, this is the call side, and 170 for the put side. So if I wanted to, I could just click right there. It will populate that call and that put, and then I would just execute that trade. But let's go back here to the singles. And I'm just going to show it this way, since not everybody has TD Ameritrade. You can do this with your Webull account, Robinhood, whoever you use if you can trade options. These are long option trades, meaning we're not writing contracts here. So you can do this with a cash account. So I would click right here because I want to take that one call, and I'm just going to click. You will not do market order. I'm just only doing this for the sake of this demo, since this is the on-demand feature and I just need it to get filled. If I was doing it with a real order, it would be a limit trade. But since this is a fake trade right here, it's not going to push an order through the market to actually trigger this. So you would never do market order. I'm just doing this for demonstration. So I'm going to click this, and you might have this little box pop up that will tell you how much it will cost for that one side of the trade. And I took that one side of the trade. Okay, so now I'm going to take the put side, which will be that 170 put. Same thing. All right, so now we are actually strangled over the well's position from when it signaled. Now, if I go to this little monitor tab right here, I can see this trade and how much it had cost. So here's my prices. What you would do right here is add up the total value for what you paid for that trade. Now, once you have that number established for any ticker, that is your total amount that you have in that trade. What we usually do, just to keep things very simple, is we tend to go for 20 to 30% profits and not even really worry about anything else. These things might chop up and down for a few days. That's cool, because if it goes up, hey, we have that call. If it goes down, we have that put. We're protected in both directions. So you establish your total cost basis for this trade, and hypothetically, just for easy math, let's say your total cost basis is $1,000. If you're just going for 20%, in the end, you want to see your total position right here, say $1,200. That would be 20%. Same thing for 30%, it'd be $1,300. And then that's when you would close out your position. When you close this out, you're going to close out both the call and the put. So just like how I bought them, you can close them out the same way. Do not cut one side of your hedge, even if you see the direction that is going in. Now, obviously, this is not financial advice. You make your own decisions in the end. But the point of the hedge, and this is why I'm saying do not do it, the point of the hedge is to have protection on both sides. It won't be a hedge anymore if you cut one side. You won't have that protection. And if that thing whips in the opposite direction of your trade, you're going to lose money for no reason when you could have been protected and made money in the opposite direction. So just like how that would have happened with buying them, you just close them out the same way. And since we already know that NVIDIA had pushed up pretty well, I'm just going to skip ahead right here so you can just kind of see some of these profits. Now, we do get profits that make more than 30%. But the thing is, you don't ever know what the market will give you. So it's okay to take your profits at 20%, call it good, and go about your life. There's nothing wrong with taking profits at any point. Keep that in mind, guys. So let's just say I wanted to close this trade out now. We can see, I just skipped ahead, and we would have a $700 profit. So if I wanted to close this out, I would do the same thing. Again, you would do limit orders, not market. And then close the other side out. And that's it. It's just that simple. Even though we did that in the context of taking single legs, that's still a strangle with how we did it. Now, that very simple way is just clicking again on the strangle one, selecting it. It gives you those contracts, and then entering that trade. And you can see it executed both that call and the put. So I hope this helps you out tremendously. We're very excited about this feature. We have had very accurate results, and you'll see for yourself. So thank you for tuning in, and we'll see you in the next one.